Today, we're breaking down why Lowe stock, ticker symbol Lowe, just jumped over 4%, what's driving this momentum, and whether it's still a smart buy right now. Let's start with what happened today. LOW stock gained about 4.28%, clearly outperforming the broader market, which was up around 1.15%. The move was largely driven by strong investor reaction to Lowe's latest earnings report, especially when compared to its biggest competitor, Home Depot, which recently reported weaker than expected results. Lowe's delivered adjusted earnings of $3.06 per share, beating analyst expectations of $2.89. In today's market, where expectations are already cautious, a solid earnings beat like this can quickly shift sentiment. But it wasn't just the headline numbers that impressed investors. It was the underlying strength of the business. One of the biggest highlights was continued growth in Lowe's professional contractor segment, often called the pro business. This segment is critical because pro customers tend to spend more and shop more frequently than DIY customers. At the same time, Lowe's has been improving its online and omni-channel capabilities, which continue to drive incremental growth. So even in a difficult housing environment, the company is finding ways to expand revenue and protect margins. And that's what really stands out. Lowe's is performing well even as U.S. housing turnover remains near 30-year lows. That resilience is exactly what investors want to see right now. Now let's zoom out and look at the stock's performance over time. Over the past 5 years, Lowe has delivered a total return of roughly 36%. While that may not sound spectacular compared to high-growth tech stocks, it's quite solid for a mature retail company. However, the journey hasn't been smooth. The stock has been volatile recently and actually declined close to 17% over the past month before this rebound. That suggests today's rally is not just about earnings, but also recovery from oversold levels. Now, let's talk about the company itself. Lowe's Companies Incorporated is the second largest home improvement retailer in the United States, with more than 1,700 stores across the country. The company sells a wide range of products, including building materials, tools, appliances, and outdoor and garden supplies. Its customer base includes both DIY homeowners and professional contractors. In addition to selling products, Lowe's also offers installation and repair services, which help increase customer loyalty and drive higher margin revenue streams. Another important piece of the business is its digital transformation. About 12% of Lowe's total sales now come from online channels, and that number continues to grow as the company invests in its e-commerce platform and mobile experience. Next, let's look at what analysts are saying. Overall, the outlook for Lowe remains positive. The average one-year price target is around $291, which implies roughly 25 to 30% upside from current levels. That's a meaningful gap and suggests analysts still see room for the stock to run. Looking further out, some projections estimate the stock could reach the low to mid-300s by 2028 in a mid-case scenario, while more conservative estimates place it closer to the high 200s. In terms of ratings, the consensus is a moderate buy. Roughly 70% of analysts rate the stock as buy or strong buy, while the remaining analysts mostly recommend holding. Now let's talk valuation. Lowe is currently trading at a forward price-to-earnings ratio of about 19 times. Compared to the broader retail sector, which averages close to 27 times earnings, Lowe's actually looks reasonably priced. That gives it some valuation support, especially if earnings continue to grow. Some analysts estimate the stock is trading at a 14 to 17% discount to its fair value, which further strengthens the bullish argument. So the big question, is it still a buy? There's definitely a strong bull case here. Lowe's is executing well operationally, gaining traction in the pro segment, improving efficiency, and maintaining solid margins. It also pays a dividend yield of around 2%, which provides additional return for investors. But it's not without risks. The biggest headwind is still the housing market. With mortgage rates remaining elevated, home sales have slowed significantly, and fewer home transactions typically mean fewer large renovation projects. Macroeconomic pressure is another concern. High interest rates and persistent inflation can reduce consumer spending, especially on big-ticket discretionary items. There's also the potential impact of tariffs, which could increase the cost of imported building materials and put pressure on margins. So even though Lowe's is performing well, it's still operating in a challenging macro environment. Finally, here are a few important things investors should keep in mind. First, the company's shift toward professional customers is a long-term strategic move that could significantly improve revenue stability and growth. Second, Lowe's is heavily focused on operational efficiency, including supply chain improvements and data-driven decision-making, which should support margins over time. And third, the company generates strong cash flow, allowing it to consistently return capital to shareholders through dividends and share buybacks. Putting it all together, Lowe's is a high-quality company that's navigating a tough cycle better than many of its peers. If you believe the housing market will eventually recover and interest rates will stabilize or decline, then Lowe could offer meaningful upside from here. But if those headwinds persist, the stock may continue to face volatility in the near term. Thanks for watching. If you found this breakdown helpful, make sure to like the video and subscribe to the channel for more stock analysis and investing insights.